Welcome back to Mastering MHA MBA. This is Chapter 13, Part 3 of 4. We have direct materials and direct labor fully untangled. Now the hard one, overhead. Because overhead is indirect and allocated rather than traced, its variances work a little differently, and fixed overhead in particular hides a variance that confuses almost everyone the first time. I will keep it clear and concrete. Why does overhead need its own treatment? Because unlike materials and labor, you cannot trace it directly to a single unit. Overhead is collected into a pool and spread across products using an allocation rate, like dollars per machine hour. To analyze it, we first split overhead into two types that behave very differently. Variable overhead, which rises and falls with activity, like power and supplies, and fixed overhead, like rent and salaries, which stays put regardless of output. Each gets its own pair of variances, so let us take them one at a time. Start with variable overhead. Its first variance is the spending variance, and it works like a price variance. It compares the actual variable overhead rate to the standard rate, multiplied by the actual quantity of the allocation base used, say, actual machine hours. In plain terms, for the hours you ran, did variable overhead cost more or less per hour than expected? If electricity rates or supply prices climbed, this variance turns unfavorable. It captures the cost per unit of activity side of variable overhead. The second variable overhead variance is the efficiency variance, and here is the subtle part. It is not really about overhead at all. It is about the allocation base. It compares the actual quantity of the base, say machine hours, to the standard quantity allowed for the output you made, multiplied by the standard rate. So if your products took more machine hours than they should have, you are charged extra variable overhead, and this variance turns unfavorable. It is driven entirely by how efficiently you used the cost driver, which is usually the same thing that drove your direct labor efficiency. Now fixed overhead. Its first variance, the spending variance, is refreshingly simple. It is just actual fixed overhead minus budgeted fixed overhead. No quantities, no rates, because fixed costs do not flex with volume. You budgeted a lump sum for rent, supervisory salaries, insurance, and depreciation, and you either spent more or less than that lump sum. If your factory lease or insurance premium rose above budget, this variance is unfavorable, clean and intuitive. The next fixed overhead variance is the one that trips people up. Here it is, the production volume variance. It equals budgeted fixed overhead minus the fixed overhead allocated to output, where allocation uses a standard rate per unit. The confusing thing is that this variance is not about spending at all, and not about efficiency. It exists only because accounting forces a fixed cost into a per unit rate, as if it were variable. When you produce fewer units than the level used to set that rate, you fail to allocate all the fixed cost, and the variance is unfavorable. It is really a measure of capacity utilization. Did you make as many units as the capacity was built for? Underproduce, and idle capacity shows up here. Step back and see the whole picture. Overhead gives you four variances. For variable overhead, a spending variance and an efficiency variance. For fixed overhead, a spending variance and a production volume variance. Three of the four behave like the cost and usage variances you already know. The odd one out is the production volume variance, which is purely a capacity story created by unitizing a fixed cost. Keep that one mentally separate and overhead variance analysis stops being scary. It is just the same price and quantity logic, applied with care to indirect costs. We tend to think of overhead as the boring, stable part of the cost structure. The last few years proved otherwise. Both energy costs and capacity utilization swung hard, lighting up exactly the variances we just covered. An update. In 2022, energy prices spiked sharply, with US natural gas and electricity costs climbing well above prior norms according to Energy Information Administration data. For factories, energy is a major overhead cost, so this drove large unfavorable overhead spending variances on both the variable and fixed sides. At the same time, supply chain disruptions and parts shortages forced many plants to run below capacity. Remember what underproducing does. It creates an unfavorable production volume variance. as fixed overhead goes unallocated across too few units. So the same period hit both overhead variances at once, spending and capacity squeezed together. Recap. Variable overhead splits into a spending variance and an efficiency variance, both familiar in spirit. Fixed overhead splits into a spending variance, a simple lump sum comparison, and the production volume variance, which measures capacity utilization rather than spending or efficiency. Hold that last distinction firmly, and you are ahead of most people who study this. Overhead is not a different kind of math, just the same logic applied with extra care to costs you cannot trace. At this point, you can compute every variance in the chapter, direct and indirect, price and efficiency, spending and capacity. But computing a variance is not the same as knowing what to do about it. Which ones deserve a manager's time? When does a favorable variance hide a problem? And how do you turn variances into learning instead of blame? That is part 4, where variance analysis becomes management control. See you there.